So, hey guys, welcome back. This is Josh, your host at Accelerated Investor. I'm so excited to be with you today. And today we're going to talk about a couple really important things. Number one, asset management and some of the dirty details around asset managing your property managers. Also, number two, we're going to talk about how to be a best-in-class operator. And also, number four, we're going to talk about why this makes me laugh because people fall in love with this. They fall in love with the acquisition, and many people are going to get in real trouble in the next 2 or 3 years because of the dynamic market if they don't be one of these world-class operators that we're talking about. We're also going to talk about rate caps, and we're also going to talk about what the Federal Reserve is doing with interest rates and why you can expect interest rates to come down roughly 24 to 30 months from now. My guest on today's episode is Randy Langenderfer. He is the CEO of InvestArk, and they own over 4,000 units of multifamily properties, including Texas, Oklahoma, Ohio, Louisiana, South Carolina, and Arizona. And he is also currently a coach in a multifamily investing organization. And also has an MBA in finance and is also a CPA. He's a fantastic interview to talk about everything I just mentioned. Here we go on Accelerated Investor with Randy Langenderfer.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, Randy, listen, thanks so much for joining me today on Accelerated Investor. I'm excited to have you on the show and peel back the onion on multifamily properties. Thanks for joining me.
Josh, thank you. It's a privilege to be here, especially given some of the elite customers you had on and guests you've had on your podcast. I feel privileged.
Oh, thanks for jumping in. Thanks for joining. So let's jump in, Randy. I always, when I get to know somebody new on the show, you guys have done 4,000 units in Ohio and then a bunch of southern states. But I always like to hear, what are you working on today? What are you passionate for, whether it's in business, whether it's personal, family? What gets you up in the morning? What gets you going? What do you like to do? Or projects that you're working on that you'd like to tell our audience about as they get to know you?
Well, I'm a long-term corporate guy, so I feel very, as I say, I'm consciously competent in my corporate job. But I am enthralled and really invigorated by multifamily real estate these days. That's where my passion is. That's where I get my feet hit the floor with a little bit of excitement each morning. And so I've got several projects I'm looking on. We have recently just, in the last several months, acquired a couple different properties, one in Greenville, South Carolina, and one in Tucson, Arizona. And so we're transitioning those, bringing them up and starting all the process, the renovations, the increase in rents, the social media campaigns, the connection with the property management stuff, all that stuff that syndicators do, and limited partners are thankful they don't have to do.
Yeah, that's great. Well, we're going to peel back the onion on that. I would like, as I've gotten to know you and kind of prep for this, I know you're from the greater Houston area, although originally from Solon, Ohio, my backyard. But you're investing in Oklahoma, South Carolina, Louisiana. So that's one of the things I think we should peel back the onion on is how does that all come together? I've done deals like that, but I'd love to hear some of your input and take on onboarding a new property that's not necessarily in your backyard. We'll talk about that. So Randy, let's talk a little bit about the market. Obviously, the 10-year treasury has skyrocketed from, 1.6 last October. We're recording this in October, a year later in 2022. And now the 10-year treasury is at roughly 3.7%. SOFR rate's gone up. Cost of capital's gone up. The Fed's doing everything they can to tame down some of the inflation. And in the process, obviously, we know the Fed has a significant control and impact on housing, because the cost of debt impacts both residential and commercial. So I'm just curious to hear your take, big picture, high level. What are some things that you're doing, changing in your analysis, your due diligence? You just acquired these new properties. How has these market shifts impacted your underwriting? How has it impacted your acquisitions? What are you looking for?
Yeah, it really has impacted underwriting. And as you said, all the turmoil or all the uncertainty in the market today is very real. And I just got done doing 2 raises, and I'd say LP investors are skittish today. They really want to understand how we as GPs are going to address that risk. And so traditionally we do it with some kind of rate cap, as you're well aware of, I'm sure of. We bought a rate cap on a property in February of 22. It was a small 60 unit here in Houston, and it had $120,000 rate cap expense. That rate cap expense, if we were to buy right now, would be probably close to $900,000.
Yes.
So it has just gone off the charts to add costs to the acquisition process, and now it's even trying to decide, well, do you really buy rate cap insurance? Because how much farther is it going to go up? Is it going to go up another 3, 4, 5%? Is the Fed going to let it go to 10% like it did back in, you and I are probably a little bit older and remember some of those days in the 70s and 80s when interest rates, I bought my first house at 10.5 FHA percent, and I was ecstatic. So we've seen some of those times. I personally don't think it's going to come back. I don't think the Fed can let it go that high because it would bankrupt the company. We just have too much debt. And whenever they do raise it, they're raising the cost to themselves too. And that would just be extreme hardship. The other thing, we are in an inflationary cycle. I don't know when it's going to end. I hope sooner rather than later. But the other side of that is that leads to inflation in rent prices too for us. So I think today, general partners or syndicators really have to become best in class operators, right? We have to push the upside, but we really have to manage the expense side of the equation, something not many of us think we can do very well, but we have to just question every penny that's going out. I'm on weekly calls with my property management companies. I'm sure you are too. And we're just being very anal about even some of the lower cost stuff. Generally you don't look at expenses unless it's a variance of a couple $1,000s. Well, we're pushing down below that and saying, where can we save money? And for the ones that I did get where there's a rate cap, they've kicked in. So that's good because our rate is, our loan is pretty much fixed for the next 3 years. So our loan is fixed for the next 3 years. The other side of that is I'm banking on history personally, because history shows that over the time of the Fed, from the time of their first rate increase, which was March of 22, was the first rate increase. The time till they start declining or reducing interest rates is anywhere from 22 to 36 months. So that puts us someplace 25, early 26, where rates would start to decline again if history repeats itself. And I'm counting for that. I'm hoping that happens and continues on that historical trend, because that would be really good for some of the properties we just bought in that 3-year cycle.
For you to refi or sell at that time, right?
Yeah.
You have the interest rate go down, cap rate go down, prices go up, and the price per door go up, whether it's a refi. It's good. Look, I think you'd agree with this, Randy, is that as long as you're taking the long-term approach, the only time you can really get bit in this industry is when you have to recap a property, sell it, or refi it at the wrong time. And right. I think we can agree that, if you're going to sell or refi, it would have been last year. Probably the top of the market, in my opinion, was July, August of 2021. And, there's still a lot of demand for multifamily, but people are not dumb. They need to get a rate of return for investors, for themselves. And so those costs have gone, rate cap costs have gone up, interest rates have gone up, and they might go up even further. But as long as you're refining or selling, right, at the right time, which could be, again, 20 to 36 months from now, and if you have a deal that you maybe promised your investors you're going to sell and it's going to come up next year, you have to be able to explain, I think, to those LPs, look, it's just not the right time. We've got to
Right.
hold on for another maybe 12 to 24 months longer. And ultimately, because those rents are going way up, and then if the cost of debt comes back down, we should be in a pretty good spot. I think that sounds like that's what you're betting on.
Yeah, I sure am. I think you're absolutely right. Is that again, as real estate investors, we have to be in it for the long term. This isn't a short-term game. We've all had some short-term wins, but the reality is we need to be in it for the long term and ride out the cycles, because we know that it's cyclatory. We know that it's going to come back as well. We just don't know exactly when.
Right.
And I think the greatest fear I have is I was in corporate America in 08 and 09, and at that time the debt markets dried up. Even good properties, and this was on the commercial side, more or less, industrial side specifically, I know you just couldn't get loans, even if they were cash flowing and stuff. Banks just didn't want to refinance. The debt markets just effectively dried up, and it was only some of those only if you had long-standing relationships with the lenders did they recapitalize. And so there will be fewer syndicators or fewer general partners in the multifamily space in the years to come, because as the markets tightened, it's going to separate those best-in-class operators from the average operators or the poor operators.
Yep, I agree.
That are on autopilot.
I agree. Randy, let's put back there in a couple things that you mentioned. First of all, let's talk about rate cap for a minute. And for our audience that may not know that term, or maybe they're newer to it, what is a rate cap? Just explain that in your own words.
I'm sorry, I should have done that first, but a rate cap, yeah, very simply for the listening audience not familiar, is insurance. We as syndicators buy insurance in a rising market like this. That one we bought in February of 22, we bought insurance for $118,000 that said if the interest rate goes up greater than 2%, this insurance kicks in and pays us the difference over the 2%. And it kicked in for us in July of 22. So between February and July was on our own, and we saw interest rates rise. But in July, it went over 2% for us in that example, in those fact pattern. And the insurance company starts to pay the overage, the difference. Now, they only pay it for 3 years, so it's not indefinite. But we got 3 years window, and like I said, banking on that 22 to 36 month window. We're confident and still bullish, put it that way.
Yeah, that's great. And then when you mentioned best in class operator, right? That's such a powerful term, best in class. Talk about that for a minute. Like when you look at people who fell in love with the acquisition, and I think we've all seen it, right? A new syndicator or group of syndicators, guys that were flush with cash or that were good at recruiting money, that could find a property, underwrite it, and acquire it. Little do they know, right, that all the work then begins, and you have to be a best-in-class operator. I certainly feel like my firm falls into that category. I know, Randy, yours does too. But what does that mean in your own words? But to be a best-in-class operator means you have to be good at what?
Well, I think as your listening audience, especially as LPs, as limited partners, you need to understand and form your own opinion of people as people bring deals to you. And for me, very simply, it's Josh's, does that person have experience? Have they seen, are they integrated? Do they have, a construction company, a property management company? Are they just doing this all by themselves? And there's no right answer. There's a lot of great people that have their own property management companies that are certainly best in class. And there's third parties that do as well as too. But the property management, as you said, we like to chase the deals and be the rainmakers. But the property is successful because of operations and property management, and that's where the rubber really hits the road. That's success versus mediocrity. Or even failure. And so, because the devil is in the details. And so to me, best in class is just saying experience, not experience just in multifamily, but experience in that market, in that sub-market. So, you'll get a lot of property managers that are great in the class C, and I'm buying a class A. Probably not a good fit. And conversely, the opposite. I mean, maybe they do a lot of class A's and I'm buying a class C. Maybe I'm buying, in the third ward of Houston, which is not the greatest neighborhood, versus one of the suburbs or something like that. Totally different marketing area.
Mm-hmm.
And so, and ask the general partner what their track record is, if they have their own company or if they're using the third party. How many times have you used this company? What's been your success rate? What's been the challenges you've encountered? Why are you using them again? Have you looked anyplace else? We as syndicators generally find somebody we like, trust on the property management side, and we tend to use them more than once. And that's okay, especially if it works. But limited partners need to understand that.
Mm-hmm.
Limited partners really need to challenge and ask questions around that.
I agree. I think being a best in class operator, in my opinion, is, look, if you look at most of the large property management companies and asset living, Trinity multifamily, which just sold to asset living. You look at any of the big ones, Lincoln. The key to me is you usually have the property management team, which is on site, right? If you have a large enough building, they're sitting there at the office. You might have a property manager, a leasing agent, an assistant property manager, a couple of maintenance techs. And then usually there's a regional, right? A regional VP. And that regional is really more of the decision maker that helps drive decisions. But that regional also has multiple properties that they're overseeing, right?
Yeah.
And that's usually more of a corporate guy, somebody that really knows a lot of the detail, but is also not there every day. So in my opinion, a big part of being best in class operator is the asset management and making sure that you as a syndicator operator have conveyed and are executing the business plan with the regional. That regional that feeds down from the regional down to the day-to-day guys who are doing leasing and evictions and and unit turns and that kind of thing. That relationship to me is absolutely critical. I just had a call this morning with one of our property management companies for about an hour and a half. We have it every 2 weeks. They manage about 750 units for us. It's four or five different acquisitions. And I'm not on the phone with the property manager that's sitting in the leasing office. I'm on the phone with the regional. Right. That to me is key. Randy, I'm sure you guys are doing a lot of that same stuff.
We do. We want them both. I want them both. I want the on-site and the regional. And we have the. It started out with the one we're doing. Mostly the on-site was. I mean, the regional started leading it, but we just changed on-sites. And so I want them personally. I want them both there, but you can't go wrong with either one of them. Just because I get the flavor for both of them, and I want to hear what they have to say, because the on-site is going to know more about specific challenges, tenant complaints, tenant maintenance issues, et cetera, et cetera. And the other thing you mentioned, is some of those bigger firms. How many properties does the regional cover?
Right.
Sometimes they cover 5, sometimes they'll cover 10 or 12, and so they start to get watered down when they start having higher ratio. And so that's another indicator to look for too. But I think he sums up very well as they're the ones on site, each and every day. And we have these I'm always amazed. We have these multi-million-dollar assets that we have a $40,000 or $50,000 employee really running.
Yeah. Right. Isn't it
scary
wild?
sometimes? Yeah. We have these multi-million-dollar assets that we own, and there's a $40,000 or $50,000 person running it in a I don't know, a $30,000 or $40,000 leasing agent or something like that. And it's like,
yeah,
God love these people.
That can work though.
Yeah, it does.
If they have some leadership, if they have some guidance, if they have some accountability, and also feel like they're part of the team, right? But to just leave it up to them and say, okay, let me get on an owner call once or twice a month, tell me what's going on, and they're driving the bus. That ain't gonna work.
And you really don't know a good one until you've had a bad one. You really, because everybody will tell you their Facebook image about how good, but until you've had a bad one, and I'm sure you've had one too along the way, oh my gosh, what did we get into? My first GP that we did was that way. We bought 139 units, myself and a couple other guys, and it was just a train wreck. The on-site manager had lived there literally 25, 30 years and raised her family there, and she couldn't tell people we were raising rents. And then the back house was a train wreck, and anyhow, so
yeah,
we had to change. And it was at that point I said, now I know.
Yeah, I was going to ask you about your start. So let's actually get into that since
okay,
you mentioned it. You mentioned you've been in the corporate world a long time. You just mentioned this 139 unit. How did that first deal come up? How long did it take you from your kind of, hey, I'm interested in multifamily, to I'm going to take down this larger asset? And I think that just to help our audience understand, a lot of guys that have corporate jobs that are high income earners. We've got other guys coming from residential that have flipped a few houses, interested in multifamily. How was the transition for you to get that first deal done?
Well, my journey started. I started out in single family. I was a hard money lender. I was living in Cleveland, Ohio at the time, as I said, and I was working with a group. I'm a Buckeye.
Yeah.
I was living in the Cleveland, Ohio market at the time, and I was flipping houses in Dade County, Miami Beach, Florida, with another group, and it had been successful. And I moved to Houston, and I got real excited. But I learned when I came to Houston, I learned about multifamily, and I just never really turned back. So I started. I was not going to pay the large entry fee to some of these multinational groups that are out there. They want $25,000, $35,000 to join, and I couldn't do that. So I just said, I'm gonna start investing in. So I found general partners that I know, liked, and trust, and started to invest with them. And I journeyed along with them and asked a lot of questions. And I asked if I could go in due diligence with them, and I asked if I could sit in some of their calls, their property management calls, et cetera, et cetera. And so I learned a ton. And I pulled down the first deal in 18. This was the 139 unit in Beaumont, lovely Beaumont, Texas.
All right.
About 150, 120 miles due east of Houston, along the Gulf. And I remember vividly, I had a friend that said, it's something that you never should buy, it was a 1965 build with flat roofs and chiller boiler system. And so for your listening audience, if you're ever considering investing in a property and somebody tells you it has chiller boiler as the HVAC and flat roofs, turn and run from it.
Got it. Yeah.
So we took down this asset, and we had a ton of property management issues, as I started to allude to. The property manager was incompetent and just a lovely soul, but she's not a business person and couldn't support our business plan to raise rents and start to make changes. And so we had to release her, and we found another person that had some commercial experience, but not multifamily experience. And she's an energetic woman, and loved her, but she didn't have any support at all. I became the regional manager. I was working 15, 20 hours a week on the calls with her, setting leasing arrangements. And I was young and dumb in my career development. And it was a great learning curve, but something I never want to repeat again.
Yeah, probably a lot of brain damage, right? I tell my audience, they know this. Like, I don't hire people to learn the job on my payroll, on my time. I hire people that already know the job and bring them onto my team so they can contribute, so they can offer something. So I'm willing to pay more for talent because they've been trained somewhere else. My dad told me when I was younger, he said, listen, when you get out of college, I want you to go to work for a big company and get trained. And then after you have all their money and all their time and all their training that they can give you that I can't afford, then come work for me. I ultimately did that. And I never went to work for my dad. I actually got into real estate instead. But I did learn from that because I worked for a big Fortune 500 company that had a lot of training. So that's one of our corporate philosophies now. I learned from my dad years ago, is that I don't have the dollars that big companies have. So I want somebody to learn the job and then bring them on. I tried, just like you did, Randy, to have my own property management company, do it in-house and teach everybody the KPIs, the leasing agreements. Oh my God.
It's exhausting.
It's exhausting. Exactly. It's a good way to put it. So you did that. What did you learn from it?
Well, I learned I never want to do it again. I'm going to use third-party property management is the short answer. But I did learn an awful lot about running an asset. And then, so the story continues that, so we had on-site property management, and then we changed the front office person, and then we got rid of the company altogether and retained the property manager. We got rid of the company and changed companies because they were really a company that, lesson learned, is they were really competent in HOAs. They had a lot of HOAs. They had only had 2 really multifamily properties, and they just weren't equipped for it. So we changed companies. And then just everybody's got to share their story. So this is the one I tell people that we own the property 2 months, and I get a call. I'm in my corporate office, and I get a call, Randy, the building's on fire. What? You're kidding, right? No, local news is out front. Nobody's hurt, thank goodness. So we lost, so I got a ton of experience. So we had 24 units out of 139 that were burnt pretty much to the ground and had to be rebuilt. And so we're in the middle of property management changes. We're trying to rebuild. We're trying to work with insurance companies to get repaid. And it was really just a lot of work, but good news. We sold it 21 months later and doubled investors' money. So
That's
that
fantastic.
had a great outcome. It was, but a lot of work along the way.
I love it. I love it.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
So if I ask you a bigger question, Randy, like what if you looked back at not only your corporate journey, because that's a big part of your life journey,
Sure.
but also this entrepreneurial journey of investing in real estate, taking down that first asset in 2018, the last 5 years or so, operating through COVID, 4,000 units as a GP, LP, both being a GP and a limited partner. If you had to look back and say, okay, I did maybe these 3 things I did right, and maybe these 2 or 3 things I didn't do right, but I learned a lot. Like, what would you pass along to our audience? What do you think those couple things would be if you had to reflect back on this journey?
Oh, that's an insightful question. Wish I had a day to ponder that.
Yeah, right. Sprung it on you.
I think on the positive side, it's both a positive and negative. I wish I'd have got started in this space 30 years ago. Sounds like when you did, or when you were along the journey. But I had a young family, and I didn't have a lot of assets, and it just wasn't going to happen at the time, because this is a capital intensive business. So one lesson would be but when I did get into it in 2014, is really in 13 when I started to get into it, I studied a lot. I didn't just blindly throw money at people and properties, because I believe really the key to a lot of this is investors, whether you're a limited partner or a general partner, you need to continue to educate yourself. I just hung up, I was on the phone call with another guy from actually looking at a property in Cleveland, Ohio, and in Shaker Heights. And, the education along the way allowed me to ask a lot of questions about the property and why we were going to do it and what were the pluses and the minuses. So education is paramount for the limited partners. If you want to speculate, put your money in the 401ks, put it in an index fund, ride out the market, whatever the market does, you'll do. That's okay. But I really think to be in this space, you have to educate yourself. And I would say I did that. I took a long-term view as well. So I realized that I had a runway in the corporate world that I wasn't going to be able to leave right away, and really not going to leave. Don't want to leave right now, but take a long view on real estate, because my property, when it was on fire and all that stuff, and I was drowning in my beer, I could have easily thrown in the towel, but it became very successful. And I owned through 2008 and 2009 personal properties and other things that looked like gloom and doom was going to happen, but in the end, it all came out.
Yeah.
So education, the long-term view, and just continue to network. Finding people that you want to work with and building a relationship. Don't ask them right away, hey, can I invest with you, or can we do a deal together? Get to know them. Find out their pluses and their minuses. And on the negative side, I think the biggest one was just I wish I'd have got started in it earlier. On the negative side, I am an analytical type. I'm an MBA and a CPA and blah blah blah. So you've probably heard of ready, aim, fire illustration. So I'm ready, aim, fire. Versus some of my friends are fire, ready, aim.
Yeah, right, right.
And so you have to know your weaknesses too, and your strengths and your weaknesses. I think I work with people very well. My corporate background brings me a lot of process, brings me a lot of collaboration and cooperation with teams, developing teams over the years, working with teams. I think that suits very well for this space. But so one of the negatives is, I guess I wish I got started earlier and just gotten after it sooner, but it wasn't going to work for me just given life where I
Yeah,
was at. So
yeah, yeah. Life kind of reveals itself at the right time, right? It's just, and you gotta, but I think what you did well, right? You took your time, did it at the right time when it was right for your family, right for your business, right for your other obligations and passions. But you certainly didn't wait very long to go big, right? 4,000 units, you're still
yeah,
acquiring things. So last and final question is over that 5-year period, some people would say, wow, you've done 4,000 units, 5,000 units, you're continuing to acquire properties today, you're operating today. So once you got into it, made that first acquisition, 139 unit, Beaumont, Texas, what do you think are some of the keys to scale, right? You mentioned network, right? Because I'm even thinking, like, I was doing some emails right before we got on this call to start recording, and was looking through, I'm like, we're fighting with our laundry company, and the attorney that I'm using to fight with the laundry company is somebody I was referred to, right? The property management company that I was on the phone with earlier is somebody that I met through another operator that I networked with, right? Most of our investors and people that are investing with us are now through referrals. It's through network, right?
yeah,
I never just, like, use an old adage, never open up the yellow pages and just call out of there to have, I don't do business with anybody that way. So to
yeah.
scale as big as you've done in the last 5 years, as big as we've done, that's obviously one of the things that you did well to scale was network. What else do you think is key to scale?
Yeah, networking is paramount. I mean, and it's like anything else. I mean, I go to church on Sundays because I want to be with believers and people who are like-minded. And so
Same.
the same thing as you go to real estate conferences and you go to real estate meetups and you listen to podcasts because you're always trying to learn. So it's that lifelong learning journey too, networking, continuing to learn. But and today I look for people that, you put it out there. I want to joint venture with people. I don't want to necessarily do stuff by myself. Some people want to do them by themselves. I want to have fewer partners rather than a GP of 7, 8 people on an asset. I found that doesn't work too well. So, but joint venturing is the way for me. I'm finding a lot of success these days with just joint venturing with other operators. And so I mentioned Greenville, South Carolina, and Tucson, Arizona. The reason I went to those markets is because those were very strong markets. They have all the fundamental demographics of high income and high population growth. But most importantly, my partners have operating experience in those areas, in those submarkets.
Huge.
In those submarkets, they've had not just once, twice, 4, 5, 6 times with success. Well, that's a lot easier for me to tell my investors about than, hey, I found a property in Greenville, South Carolina. I live in Houston, Texas, and trust me, we're going to make this a winner.
Yeah. Yeah.
So joint venturing, education, networking, I'm going to summarize as continue to be a lifelong learner.
Leveraging other people's experience, right? Like
Yeah.
that say, if I'm going to associate with this person or be a GP with this person, now I get to leverage or inherit, if you will, their experience, because I'm now on the same team. And when I talk about the team, the GP, you're using obviously your own experience, but theirs as well in your pitch deck and your marketing and your conversations and your emails, social media. You're on a presentation with investors. People are inside your investor portal. You all become part of the same conglomerate, if you will, the same team. And you get to leverage other people's experience that maybe you don't have in a certain area or a certain type of experience. We're heavily focused on construction, right? We do a lot of, I would say, heavy value add where we're putting in 7,000 to 10,000 a unit. We're buying a lot of 60s, 70s, 80s vintage in Ohio, Cleveland, Columbus, Cincinnati. But we own the construction company. That's our silver bullet, right? So we don't just outsource.
That's huge.
It's huge, right? So you got to have that one thing. That one thing could be a partner that Randy has that has some sort of GP experience in Greenville, South Carolina, or it could be that you own the construction company, or it could be that you've done other deals in Tucson, Arizona. You have to have some of that leverage to be able to sell yourself, right? So to sell yourself to investors, I think, is key. And you've obviously done that well, Randy, growing 4,000 or 5,000 units in 4 or 5 years. It's been pretty amazing to watch.
Well, and I can tell you the encouragement to your listening audience is, look, I'm not the brightest crayon in the box. If I can do it, anybody can do it. It just takes persistence and time. This really, this isn't brain surgery, as you know, and really the persistence, staying in the game for the long term, persistence and doing what others, follow the success that others have had and replicate it. Whether your listening audience is a 20-year-old or a 50 or 60-year-old, it can be done.
Yeah.
It's really achievable.
Randy, your website is invest-ark.com. When our audience goes there, what are they going to find? And is there any other places where they should engage with you online?
I'm on LinkedIn, Facebook as well. Happy to talk to any of your listening audience. On that website, you'll find some free educational materials. You'll find our portfolio that we have. There's a contact me tab on there where you can schedule a meeting. Love to chat with you about anything real estate. And Josh, I just really want to thank you for letting me be on your show today.
Yeah, love it. I got to ask you one final thing, because you're from the greater Cleveland area. What is maybe one memory, one thing that sticks out about your time in Cleveland? You're from Solon. We were talking about this before the show. My daughter just had a volleyball tournament in Solon last weekend. So we're from the one of the same types of areas. You're from the east side, kind of from the west side. What's one of your favorite memories from the Cleveland area?
I can tell you the good and the bad again. So I'm a lifelong Ohioan. I grew up in Findlay, Ohio, on the west side of the state, and lived in Toledo for about 7 or 8 years, and then came to Solon for many years. But the beautiful part about Ohio, as I tell people, there's in the whole Midwest, but Ohio especially, there's nothing more beautiful than Ohio in the spring, summer, and fall. And the Great Lakes just stand out in my mind. Lake Erie is just such a treasure. Down here in the Southwest today, we have lakes, but I'm not near any of them, and they're not as accessible, and they're not as big, and they're not as beautiful as Lake Erie is. So I would say, and also you got to talk about in the Cleveland market, you got to talk about the metro parks.
Yeah.
You just don't see anything like that in the South. I mean, something people in your neck of the woods take for granted, my friend.
Oh yeah.
The metro parks.
Me included, one of some of the best in the country.
Yeah, they truly are. And you got the whole downtown area that's being revitalized. I was formerly employed at University Hospitals Health System, and and that whole healthcare mecca, I'll call it, in Cleveland, between the clinic and UH is really second to none in the country. And you got Case Western Reserve, and you got Fortune 500 companies. Cleveland may have got a bad rap many years ago, but it is definitely home for me, and get back there as often as I can.
Yeah, I love it. Put a smile on my face today, Randy. I appreciate that very much. Listen, thanks so much for joining us. Again, for my audience, go to invest-ark.com to spend some more time with Randy, or Facebook or LinkedIn. Randy, thanks so much for joining me today on Accelerated Investor.
It's my pleasure, Josh. Have a great day.
Well, there you have it, guys. Listen, I hope you enjoyed that episode of Accelerated Investor with me and Randy. As always, number one, don't forget to subscribe to Accelerated Investor. Hit the subscribe button right now, wherever you get your podcasts, so you never miss another episode. Number two, make sure you leave us a rating and a review. Like, that's the most important thing to me, to know how we're doing, whether you enjoy the episodes, what you're getting out of it, what you think some of the best in class episodes are, what you enjoy the most. Please let us know. And also, don't forget to share this all over social media. I would be so grateful if you would share these episodes on your Facebook, on your LinkedIn, Instagram, Snapchat. Let everybody know that you're engaging in Accelerated Investor with me, and this is where you're getting your education from. Man, that just is so, so important to me. And finally, listen, if you're looking to take your business to the next level, you're looking to joint venture with GPs, LPs, property managers, you're looking for coaching, mentorship, and mastermind, go apply for the Forever Passive Income Mastermind at joshcantwellcoaching.com. We'll see you next time.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, Visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.